Assalamu alaikum friends, welcome to lecture 32 of SBR, IFRS 10, which is Consolidated Financial Statement. Now, IFRS 10 I have divided into two parts, okay? So this is part 1 of 2 and the next lecture, which is lecture 33, will be part 2 of it. So in this part, we are going to focus on definitions, consolidated statement of financial position, the statement of profit and loss, control, impairment of goodwill, exemptions from consolidation. So, starting with the definition, okay, IFRS 10 says, okay, that a parent, okay, needs to prepare consolidated financial statements. Okay, so these are the following definition. You need to understand what is a parent and what is a subsidiary. Okay, a parent is an entity that controls another entity. A subsidiary is an entity that is controlled by that entity, another entity, controlled. So parent is controlling the subsidiary. Parent is having a control over a subsidiary. You understanding? An investor controls an investee. Who is the investor? The parent. Who is the investee? The subsidiary. You need to know these definitions. Why? Because as we all know, the importance of the standard for your SBR is that IFRS 10 comes in your question number 1. Okay, consolidated financial statements, you are going to get 100%. You are going to get this question in your SBR exam in your question number 1 for 30 marks. So we all know, okay, this is a default standard that all of you must know. IFRS 10, you cannot skip it. So it is not just a calculation. Okay, don't worry too much of numbers calculation preparing consolidated statements. No, you also need to know the theory part of it, the discussion questions where you need to write. Yes, that 30 marks is not just fully numbers. It is based on writing also. So you need to know these definitions. What is control? In what situations you are controlling another entity? You have to know this definition. That's why I've included it in this slide. Okay. So an investor controls an investee when? You need to know this. Okay. If a question asks you, you need to write. When an investor has the power over the investee and investor is able to investor is exposed or has rights to variable returns from the investment in the investee. Third, investor has the ability to affect those returns through its power. So you need to know these 3 points. It's a must. Okay, if the question asks you, you can write these 3 points. If the question does not ask you, then there is nothing, that's a good luck, right? You didn't get, but if you get, you have to be in a situation to explain this. Okay, because if these 3 situations are there, then you have to prepare consolidated financial statement. Sometimes the question is not very straightforward. They will not give you a question that this company has acquired 60%, this company has acquired 50% of this company. No, sometimes they will not give you straightforward questions like this. If you're lucky, yes, but if you're not so lucky, they will twist this question. How? They might give you some facts, then you have to decide whether the entity has a control over another entity. If they have, prepare consolidated. If they don't prepare consolidated financial statement. That's the reason you need to know these 3 points from IFRS 10. Okay, IFRS 10 is more of calculation than discussion, which is a good thing for you. But if a discussion question is asked, it could be asked from this area about the control part. You need to know the definition of control. Okay, now moving on to the next. So consolidated financial statement. What is the meaning of consolidated? Consolidated means you are adding up the parent as well as the subsidiaries, assets, liability, equity, income and expense, and also the cash flow of both the parent and the subsidiary and putting it under one financial statement, that is known as consolidated financial statement. Okay, now from the point of your exam, it is always asked in your question number 1. Second, remember, this is SBR, this is not financial reporting. In your F7 you are asked to prepare full consolidated financial statement, but in SBR you will not be asked to do so. Then what will you be asked to do? Instead, you'll be asked to prepare extracts from those statements and to explain the accounting numbers. You have to be in a position to explain the accounting numbers. That's why it's very critical for you to understand the reason behind why you are getting a certain number. You just cannot memorize the number and go, because this is not financial reporting where you just have to prepare some statements and then show and balance the financial statements and you'll get marks. No, this is a professional paper. Okay, you have to explain. So in order for you to explain, you have to know it. That means you have to thoroughly know the reason why you are doing a certain working. Okay. But when you're practicing, okay, when you start with SBR, my advice is first prepare a full consolidated financial statements. Then go to the extracts. Do the difficult part first and then come to the easier part. Extracts is easier than the full consolidated financial statements, right? Because it's less time consuming also. But to prepare extracts first, you have to know the full consolidated financial statement. Even if in SBR, they will not be asked. Okay. Now, let's start with consolidated statement of financial position first. Okay. Whenever you are asked to do this in your SBR exam, first the group structure. Working number one is a group structure. What is group structure? Basically, you don't have to do this group structure. In the question itself, you will know, right? If a company, okay, acquired another company and the voting is more than 50%, that means they have acquired more than 50%, then it is said to be that they're having a control, because more than 50% is control. That means then only you have to prepare a consolidated financial statements. So this percentage will help you. If it's 50% and more, consolidated, which is always the case, right? Otherwise, why would they ask? If it's less than 50%, then it's not consolidated. Then it's some other standard, right? You have to see whether it is an associate or it is a financial instruments. If it's less than 20%, it falls in under IFRS 9, financial instruments. If it's between 20 to 49%, it's an associate, which is IS 28. Okay. And if it's more than 50%, then this is the standard. IFRS 10 deals with it. You have to know the three separate standards. Okay. We have finished IFRS 9 and IS 28 previously. Okay. Now we are in this one. So clearly see this image. What can you see? A is the parent. If you see the arrow, it's going downwards. A have acquired B and it is 70%. A have also acquired C, 80%. Now from this picture, you can tell both are subsidiary. Both B and C are subsidiaries of A. That means when you're consolidating, you have to consolidate both B and C with the A. Okay? Because they are more than 50%. Now, group statement of financial position as at the reporting date. Okay? Working number 3 is the goodwill. So this is how it will look like. Okay? This is a snapshot of how your group statement of financial position should look like. You will be having a goodwill. Remember this. Whenever you are preparing a consolidated statement of financial position, you will always have a goodwill. Always. For that, there's a separate working. That's why in bracket, we have put working 3. It could be any number, 1, 2, 3, working 1, 2, 3, any. Okay. So goodwill. Then you'll be having assets which you need to add the parent with the subsidiary. P stands for parent, S stands for subsidiary, P plus S. So assets you have to add both. Then equity capital, only the parents. Only the parents. Retained earnings, separate working is there. Okay, we'll go through them. We'll go through in detail whichever is there, which is labeled as working. We'll go in depth. How goodwill is calculated, how retained earning is calculated. Next is other components of equity. This also has a separate working. Non-controlling interest. This also has a separate working. All this will be added. And liabilities, again like assets, parent plus subsidiaries. So this is how your group statement of financial position will look like. Okay. Now coming to this thing. You need to do the following here. Remember, eliminate the carrying amount of the parent's investments in his subsidiaries. You must have seen in the parents, only the parent. Forget about the subsidiary. If you see the parent's financial statement, you will see under non-current assets something like investment in subsidiaries. That will be eliminated now when you're consolidating, right? That will be replaced by the goodwill now. So in your consolidated, rather than that, now you're writing goodwill. So eliminate any carrying amount of the parent's investment in subsidiaries. Second, add together assets and liabilities of both the parent and the subsidiaries in full. Then, for share premium and share capital, only the parent. Do not add it with the subsidiary. You need to remember these points in mind while doing it. Next, whatever the workings are there from 2 to 5, goodwill, NCI, retained earnings, all this needs to be shown in your exam. Let's understand this. You need it to calculate goodwill, to calculate non-controlling interest, and to calculate group reserves. You need it. You have seen in your paper by now, past paper, that all the questions almost always ask you to calculate goodwill, NCI, group reserve, goodwill, NCI, group reserve, goodwill, NCI, group reserve. So by now you should be very thorough with it. Okay, maybe some additional things they might be asking you to do, but these three are very common: goodwill, NCI, group reserve. Next, net assets, again very important. This also will be there. Okay, when you're calculating consolidated statement of financial position, you need this working unit. Okay, so this working sets out the fair value. Remember, fair value of the subsidiaries net assets at acquisition date and the reporting date. Reporting date means whatever is there in the balance sheet, statement of financial position. And at acquisition, they will give you in the question. Okay, equity capital. This is, we are talking for the subsidiaries. Okay, share premium. Share premium and share equity capital will be same, both at acquisition and at reporting date. Okay, this will not change. Other components of equity, this will change. Retained earnings, there will be difference. Goodwill in accounts of the subsidiary, you have to deduct it. Why? When you're calculating net asset, this goodwill which was already there in the subsidiary will be cancelled, because there will be a new goodwill which will be calculated when you are consolidating. That's why you're deducting it. That's why you see it's in a bracket. Then fair value adjustment needs to be done. This fair value adjustment they will tell you in the question. Okay, maybe for 1 or 2 items. Mostly for 1 or 2 items. More than 2 items they will not give you for fair value adjustment. So accordingly you have to add or deduct. Post-acquisition depreciation or amortization. If there is a fair value adjustments for a non-current asset, let's say, which they didn't take before, and now since you are taking it, there will be an additional depreciation which you have to deduct, which was not there at the acquisition date, but at the reporting date you have to deduct. And if it's an intangible assets fair value adjustment, amortization, you have to, so don't forget to take depreciation or amortization. Okay, if it's a tangible asset, it will be depreciation. If it's an intangible asset, amortization. So since depreciation and amortizations are done at the year end, nothing to do at the acquisition date. It's only at the reporting date that change will take place. You need to deduct. Okay, then whatever it is will go to working. This net asset, you are calculating this net asset of subsidiary acquisition. Can you see? At acquisition only will go to working 3 when you're calculating goodwill. You need this for your goodwill. That's why you're doing this as working number 2. You need this net asset of subsidiary for your goodwill. So not the reporting one, only the acquisition. Okay. Then you might ask me, if we only need the goodwill at acquisition, why are we taking at the reporting date also? There's a reason why. Because that change from the acquisition to reporting date, that change is known as post-acquisition profit, which you need for group reserves later on. That's why we are taking these 2 columns. Now do you understand? So from this working number 2, we are using it in 2 places. One, net asset at acquisition for your goodwill. Second, for your group reserve, group retained earnings, the change, the difference between acquisition and reporting dates, net asset. Now, goodwill. Goodwill, this are fixed standard. This is fixed method. Okay, you can memorize it. It will not keep changing from question to question. So fair value of purchase consideration, they will give you. With that, you add your NCI at acquisition. Okay, there's a 2 star. The reason why there's a 2 star is because NCI can be calculated using 2 methods, which I will explain you in the next slide shortly after this. Okay. After that, you deduct your fair value of net asset. Remember, in your working to just in the previous slide, we calculated net asset at acquisition. That net asset now you need to deduct. That's why. So without that, you cannot calculate goodwill. That's why that is working number 2 and this is working number 3. Please understand the logical sequence also. You need the previous one for the next one. That's how they decide the number. This is working 1, this is working 2, this is working 3. This, how will you understand what is which one is which number? How to put? Through experience. You keep on doing questions, you will understand the nature. Without this, if you are trying to do the first question in SBR, let's say, you will not understand. You will not understand which one should be working 1, 2, 3, 4. Okay? You will not understand the logical order. But once you keep doing 10, 20 questions, you will have an idea because all are same. All same of order. Okay, so do as many questions as possible to gain that confidence because experience will help you. What should be done next and what should be done before. Nothing can beat that experience, trust me. Okay, next, working number 3, goodwill. So that's how we calculate goodwill. After that, if there is any impairment, needs to be deducted. If there is no impairment, khalas, goodwill at acquisition is a goodwill. But if there is an impairment, you need to deduct that and then you will get a goodwill, which will go to your consolidated statement of financial position. Next, remember two stuff for NCI? I told you, because NCI could be calculated using two methods. This is the first method, which is known as full goodwill method. Most of the time in your SBR exam, this first method is given. First method is used. And this is usually given in the question. They will give you the fair value of NCI. Okay. Next method, sometimes they give, sometimes, not every time. This is known as the percentage of the fair value of the subsidiary's net assets, NCI percentage. Let's say NCI is 20%. So you will take 20% of the net asset of the subsidiary. That will be your NCI. Okay. That will be your NCI when you're calculating goodwill. And this is known as partial goodwill method or proportionate goodwill method. Where you are given the fair value of NCI in your question, that is a full goodwill method. Okay. And this net asset at acquisition you have already calculated in working number 2. If you are using the second method. But you should know both the methods, by the way. Okay. Because you don't know in your exam which one you might get. Even if I say the first method is more common. Now, working number 4, NCI. This all are fixed method. Okay. Working 2, working 3, working 4. Working 4, NCI. So NCI valued acquisition. This will come from working 3. Whether fair value or proportionate. Whatever it is, that NCI you have to carry forward. Next, you have to add your NCI percentage of post-acquisition movement in net assets. You see, you need your working from places to places. Even here you need it. Whatever, so the difference between your acquisition, remember there were 2 columns in your net asset. On your left side, there was an acquisition, on right side at reporting date. So the difference between that two is your post-acquisition movement in net asset. So you have to take that difference and on that apply the NCI percentage. Because we are calculating NCI. What is the NCI share of post-acquisition profit? That's what we are adding with the NCI, opening balance of NCI. That's what we are doing here. So you add it. Then you deduct the NCI share of goodwill because it's an expense for goodwill. Sorry, expense for NCI. Goodwill impairment is an expense, so you deduct it. But only if the fair value method has been used. Why? Why? See, if you're using a proportionate goodwill method, okay, the proportionate goodwill method only measures the goodwill for the parent. That goodwill is only for the parent. So even the impairment will only go for the parent. But here, if you are taking the full goodwill method, it includes both the parent and the NCI. So that's why on that you can take the NCI percentage and deduct the impairment if you are taking the full goodwill method. So this is only applicable for full goodwill method. Okay, you take the NCI percentage of goodwill impairment. Through questions we'll do this. Okay, if you're not understanding at the moment, don't worry, don't panic. We have questions. We have through numbers you will understand this better. But for now, just remember this much. Next, so whatever it is, that will go to your consolidated statement of financial position. In the very beginning, we have seen that the format of consolidated statement of financial position. NCI will go there. This is this NCI. Working number 5, retain earnings. First, the parent's share. 100% of the parent will go. With that, you have to add the post-acquisition profit. Okay, which we have already done in working 2. Remember, I told the moment between acquisition and reporting date of the net asset, that is known as post-acquisition retained earnings. So you take the group share. Let's say you have acquired 80%. So 80% of that group's retained earnings you have to add. Next, any gain on bargain purchase. This gain on bargain purchase, you will get it through working 3. Working 3 was when you're calculating goodwill. Okay. This is not very common, very uncommon. Very rarely you might get this. But if you get it, you have to add it. Any goodwill impairment, deduct, because it's an expense. You are calculating retained earnings basically. Okay. So from retained earnings, all expenses needs to go. So goodwill impairment. But remember, goodwill impairment is only the parent's goodwill impairment, because when you're calculating NCI in the previous working, you deducted the NCS goodwill impairment. Here you are deducting the parent's goodwill impairment, only the parent's percentage. Okay, when you're calculating return earnings. This also comes from working 3, because obviously first goodwill needs to be calculated, right? To calculate impairment on that, that's why. Then PURP stands for provision of unrealized profit. Okay, this needs to be deducted if the parent was the seller. Remember, parent, because parent is the one who is going to realize this profit, right? For him, it's going to be the unrealized profit. So for parent, because the return earnings we are calculating from the parent's point of view, so we deduct it if the parent was the seller. It's very important in your consolidated statement of financial position, who is the seller, the parent or the subsidiary. If it's the parent who is the seller, you deduct normally like this. If it's the seller who is the if the subsidiary is the seller, then you don't deduct from this place. You understanding? So that whatever the final result goes to statement of financial position. Okay, so if NCI, this is for goodwill impairment, that 2 star. If the NCI was valued at fair value of the acquisition date, then only the parent share of the goodwill impairment is deducted from retained earnings. Okay, this is only when NCI is done at fair value. You deduct the group's share of parent share of goodwill impairment from retained earnings. Next, other components of equity. This is little easy because much working is not required in this. Mostly it is NCI, retained earnings and goodwill. These 3 places heavily workings are required. Other places is less. So you need to place less stress on the other workings. But goodwill, NCI and group retained earnings very important, and it has a lot of workings. So other components of equity like retained earnings, similar to retained earnings, take 100% of the parent. Next, when you're taking the subsidiary, only the group's share. If you have acquired 80%, then only the 80% of the post-acquisition profit. When you're taking the post-acquisition, here also, in your working to remember that table we have done, at acquisition, at reporting date, the difference between that two is known as post-acquisition. Other components of equity. So that difference, you have to take the group share and add it here. Then it goes to consolidated statement of financial position. That's it. This is a very small working. Next, we are moving on from consolidated statement of financial position to consolidated statement of profit and loss and other comprehensive income. I've used the initials PLOCI, profit, loss, other comprehensive income, because I don't have space to write the whole thing, but understand. So here, this is how a group statement will look like, profit and loss. First, you start with revenue. Revenue, both parent and subsidiary you add. Cost of sales also add both. Gross profit. Then gross profit don't add both. Okay, this gross profit is cost of sales you deduct from revenue. Okay. Operating cost add. Then profit from operation don't add. Investment income add. Finance cost add. Profit before tax no need to add. You will get it. Income tax add. Profit for the period, then you will get it. Okay, wherever I have shown addition you have to add. Wherever I have not shown addition you will get it by following it. You don't have to add. Next, after profit from the year, I don't have full space on that screen to show you down, so I've taken it to the next slide because it's a continuation of the previous slide. Okay, profit for the year. After that, this will come below that. Other comprehensive income. This also add both. Then comes total comprehensive income. How? You add your profit for the year with the other comprehensive income and you will get your total comprehensive income. So remember, this part is very important. Profit attributable to. You have to divide this. 1 to NCI, 1 to the parent. 1 to NCI, 1 to the parent. This is only the profit. Okay. But we have already worked through our working number 4. What is the profit that goes to the NCI? Correct? So equity holders of the parent is the balancing figure. Remember that profit for the year? That profit for the year only you have to get here. But since NZ you have already got from your step 4, for the equity holder, for the parent is the balancing figure. Same for the other comprehensive income. No, sorry, not other comprehensive income. Total comprehensive income you have to divide between parent and NCI. NCI already you have done through step 4. But equity holder, same like profit, is the balancing figure. Remember, it's your profit and total comprehensive income, TCI, not other comprehensive income, that is divided between parent and NCI. Please understand this. Okay. Now, complete the pro forma. So, this is what they have done in the previous slide. They have added the parent and the subsidiaries income and expenses line by line. Okay. Not only income and expenses, but also other comprehensive income. Line by line they have added. Okay, but you need to remember something. What if that subsidiary was acquired in the mid-year? What if it's not for the whole year? Then you have to proportion it. Okay, all income, all expense, all other comprehensive income of the subsidiary you have to proportion it. Let's say it's for 6 months, then you have to take only the 6 months income, only the 6 months expense, only the 6 months other comprehensive income from the subsidiary. That's how you have to do. Okay, not for the entire year. And any intra-group revenue. Okay, any intra-group income and expense, any intra-group transactions. Okay, unrealized profit on intra-group transaction needs to be eliminated. Why? Because they're part of a group, they are one. If you're doing this transaction with an external party, then only you are actually making a profit. But here you're not actually making a profit, you are part of one group only. So even if you're selling to each other, one party is making a profit, is actually not a profit. So you eliminate any intra-group income or expense or sales. Also, any dividend that is received from the subsidiary, eliminate. Now, calculate the profit or TCI, total comprehensive income, that is attributable to the NCI. Okay. So, if it's the profit or the TCI, you have to prorate if it's for the mid-year. If it's not for the entire year, based on the number of months, you have to do this also, profit and TCI. Okay. Then, if S is the seller, remember P was the seller, we took it in the retained earnings. But if S is the seller, subsidiary is the seller, you deal it in the NCI part. Because subsidiary is the NCI. Parent is the parent, the major shareholder. If S is the seller, you deduct here. And any excess depreciation or amortization, you deduct. Goodwill impairment for NCI, deduct. But only if fair value method has been used. If it's the other method, then you don't deduct anything. And apply NCI percentage to it. Apply the NCI percentage at the end. After you have taken the profit, unrealized profit, depreciation, goodwill impairment, then you apply the NCI percentage. If it's 20%, then 20%. Once it's done, that profit or TCI is said to be attributable to the NCI. Okay, then equity for the parent is the balancing figure. Now we are coming to the control, a very important thing. See, we said that you need to have more than 50% of ordinary shares of another entity to have control. But sometimes even if you're having less than 50%, you still can have a control. This is only for a discussion question. If SBR asks a question to write, but if it's calculation wise, like if they tell you to prepare consolidated and all, go by the percentage. If it's more than 50%, you consolidate. But if they tell you to write on control, like something to write, then you can use this slide. Okay, these are the conditions. Number 1, if you can access the majority of the voting right. Number 2, there are some arrangements between investor and the other parties. Third, holding less than 50% of the voting rights with all the other equity interest held by a numerically large, dispersed and unconnected group. Fourth, holding potential voting rights. How? Maybe your shares, maybe now you are having a convertible loan. So this loan can be converted to shares, that means which will give you a higher voting right in the future. So if you're having a convertible loan, which could be convert to equity shares. That also can give you control. And finally, the last one, the nature of the investor's relationship with the other party, which may enable the investor to exercise control over the investee. So if these points are there, you have to see in your case study, you have to see in your scenario whether the company given in your question has these characteristics or not. They will tell you clearly. If they have, yes, control is there. Consolidate. If they don't, then they don't have control. Now we'll be doing questions, few questions before we move on to the next topic, which is impairment of goodwill. There are two questions here. One is test your understanding 2 and the other one is test your understanding 3. Before I attempt 2, let me finish with test your understanding 3 because this is easier than test your understanding 2. But please understand, in your SBR exam, they will not ask you straightforward questions like this. Okay? This is only for the learning purpose, okay? To understand which company controls another company, only to understand that. This is just for understanding purpose, okay? But your real exam will not be this easy. So test understanding 3. You have been given 3 companies, H, S and T. Okay. Now the question is, does company H have a control over T? Okay. So we know H controls S because 75%, which is more than 50%. So control. We also know S controls T. Why? Because this is also more than 50%. So again control. But what about H to T? Does it have a control? See, H has a control over T. How? Because H has a control over S and that S has a control over T. So through S, H will have a control over T. Are you understanding my point? Because H can control S, right? Because H can control S, so through that even S can control T. So through that S, H can also control T. That means all these 3 companies form a group. All these 3 companies form a group. They come under a group. Okay, where H is the parent. Okay, H is the parent, S and T are the subsidiaries. You understanding? S is the direct subsidiary of H, T is the subsidiary of H. Is the okay? So through S, T is a subsidiary of H, not directly a subsidiary to H. So that's how they have a control. So that means the question is, does company H control company T? Yes, it controls company T through the control of S. This is how you need to explain your answer because it's more than 50%, right? Now, going back to test understanding 2. Here you need to discuss how Parsley's investment in the ordinary shares of Oregano should be treated in the consolidated financial statement for the year ended 30th April 2004. Okay, this is about shares. You need to read this information very carefully. Okay, now Parsley holds 40% holding in Oengo. Does this 40% give control? First tell me. No, it doesn't. Because it should be more than 50%, but we need to read other information. We cannot just take the 40% in isolation and decide there is no control. You have to read more information if it's given so. If it's not given, if only it is said 40%, then you can assume there is no control. But if other information are given, yes, you have to take those information into consideration. So another investor has a 10% shareholding, while the remaining voting rights are held by thousands of shareholders. That means this thousands of shareholders are holding small percentages. So they do not have a control. Understanding? Major is Parsley only with 40%. The balance 10% is by another shareholding. And so that means 50% went. The remaining 50% is held by shareholders, which are held by thousands of shareholders. So none of whom eventually hold more than 1%. No one holds more than 1%. Each one holds 1% or even less than that. So that means the remaining 50%, they do not have a control. Okay. Parsley also holds debt instrument that could be converted into ordinary shares at a price of 4 per share. And at 30th April, their shares are trading at 3.8 per share. If the debt was converted into ordinary share, Parsley will have 60%. Now it gives a control. If you are converting debt to share, so that share will be added to your existing share, that is 40%, which will give you another. That means you add 20% with 40 and it becomes 60. So after that conversion, now you are holding 60%. Now it is giving you a control because it's more than 50%. And also they are taking similar activity, which would benefit from synergy. You need to discuss. The question asks to discuss. You cannot give your answer directly saying now it has a control. No. But how do you build your answer? How do you structure your answer? That's the main in SBR that one needs to know. First, you need to give the 3 bullet points of control, which we went through previous slide. I was explaining what is control, the 3 points that you need to memorize, that you need to give the definition. So what does investor say? An investor controls an investee if the investor has 3 things. Number 1, power. Power. Investor should have power over the investee. Second, exposure or rights. Exposure or rights to variable returns. Third, ability to use this power to affect the amount of the investor's return. Ability to use power. You can complete the sentence, okay? I'm not completing it because you know it. Okay? So you have to see all these 3. Whether it has a power, whether it has the ability to use that power, and the exposure to variable returns. Okay? So you have to take mostly the voting rights. The main thing is here is the voting right. That will tell you how much control you have or not. Okay? One voting right is already the 40%. The remaining comes from your convertible options when you are able to convert into shares. So this depends on your right. Do you have the right to exercise? If you exercise, what will happen? Okay, this is like an option. So since this is an option, okay, it only matters if you can exercise that option. That will give you the control. Otherwise, there will be no control. Okay. So number 1, when it comes to option, look at the exercise price. Okay. If you see exercise price is 4, whereas the market price is 3.8. So will you exercise? Will you exercise this? No. You are most likely not to exercise the option. Right? Because exercise price is more. Next, you have to see whether the parties that have these rights, can they benefit from the exercise of this right? That's the next thing. Okay. So now we'll link this to the case study. Coming to Parsley. So Parsley has this voting rights. Okay. They are currently exercisable. So you have to factor this into the assessment whether control exists or not. Okay. If you see, you are more likely to exercise the option or no. You are not likely to exercise the option because exercise price is 4, which is greater than your market price 3.8. You see, which is another meaning of this is out of the option. The term is known as out of the option or out of the money. Sorry, out of the money. When your exercise price is greater than your market price, it is known as out of the money. Okay. So here, Parsley will delay taking up these voting rights. They might not take these voting rights. Okay. But remember, this is not deeply out of money. Why? Because you can also have some benefit. Some benefit will minimize the loss of exercising it because you are going to have some synergies. Okay. So this would suggest that it is likely Parsley will exercise the option. Why? Because if you see, it's not very deeply out of the money. The difference is not so much, and also you are going to have some benefit of synergy. So even if you exercise, you are not going to run a loss. Okay. So Parsley is more likely to exercise this option. Therefore, based on the above, okay, Parsley has a control over Orango and therefore it has to be consolidated. Okay, this is your judgment. Now we'll be moving on to the impairment of goodwill. Impairment of goodwill. How do you account for it with an NCI? Okay, IS 36 says goodwill needs to be tested for impairment annually according to IS 36. We went through that earlier, right? But goodwill does not generate any independent cash flows. Therefore, it is tested as a part of a cash generating unit when you're testing the impairment. And for exam purpose, a subsidiary is normally designated as a cash generating unit. Okay? There are two methods in which you can calculate NCI. We know that. One is fair value method, the other one is proportionate method. When it's a fair value method, okay, you add your goodwill to your other assets of the subsidiary and then compare it with the recoverable amount to find the goodwill. Then the impairment of goodwill needs to be allocated between NCI and the parent based upon their respective shareholding. Let's say NCI is 20%. So goodwill impairment 20% will go to NCI, the balance 80% will go to the group, the parent. This is only for fair value method, because fair value method NCI, it's a fair value, right? It includes both the NCI as well as the group. So you need to allocate it. But when it comes to the next method, that is proportional method, only the parent is there. So that allocation does not come. Whatever goodwill impairment is there, totally goes to the parent. Okay? Because only the goodwill that goes to the group or the parent is calculated. So here you need to do one thing. In order to address the problem, there's a problem. Because the goodwill that you have calculated based on proportionate method is only for the parent. You need to include the NCI percentage also to find impairment. This is only for finding impairment. Okay, you need to. So the goodwill that is given to you is only for the parent. You need to add the portion of the goodwill of the NCI to that. That means the total goodwill. How do you do this? This is how you do it. The goodwill that is given to you, you gross it up. You gross up that goodwill based on the NCI percentage. So once you gross up, okay, the portion that goes to NCI of that goodwill also is included there. That is known as total notional goodwill. This total notional goodwill only you compare it with what? With the recoverable amount to find impairment. And only the parent share of the goodwill is recognized in the group accounts. Okay. The same way how only the parent's goodwill is recorded, even for that impairment loss on that goodwill, only the parent's share is there. Okay. That grossing up is only to compare it with the recoverable amount. Please understand this. You are not using it thereafter. The total notional goodwill you only require it when you have to compare it with the recoverable amount to find the impairment. After that impairment, whatever impairment is there will go to parent. The parent share needs to be recognized. The NCI percentage will not recognize. Why? Because this NCI is based on proportionate method. Now we'll be doing questions. Illustration for impairment of goodwill. So here A and B NCI has been calculated using two methods. One is fair value, B is proportionate method. And now we'll see how impairment differs. Okay. Recoverable amount has been given as 64 million. Okay. A owns 80% of B. So NCI will be 20%. And carrying amount of the net asset is 60 million, excluding goodwill of 8 million. Goodwill is not included in that net asset. Okay. So now let us do the NCI, the first one. When you measure the NCI at fair value, what would be the impairment? Okay. Remember, when you're calculating NCI at fair value, the full goodwill has been calculated. Okay. So here you need to add the goodwill with your carrying amount. So net asset was how much? 60 million. Okay. And your goodwill was 8. So your carrying amount becomes 68. Okay. This is your carrying amount. Then recoverable amount. What is the recoverable amount? It is 64. 64 is the recoverable amount. So the goodwill is how much? 4. Sorry, 4 is the impairment. Goodwill has already been given as 8. So this is the impairment. And remember this impairment. This is NCI at fair value. You have to proportion it between the NCI and the parent. Okay. So if you see here, goodwill is 8. And if you reduce it by the impairment, 8 minus 4, it will be 4. Okay. So this 4 impairment will go where? Which place? P&L as an expense. And how will you allocate it? You will allocate 80% of it, which is 3.2, and 0.8 will be to the NCI. This is 20% of that 4 impairment. So this goes to NCI, this goes to the group or the parent. Okay. Now let us do B, where we are using the proportionate method. Remember, you have to gross up the goodwill. Notional goodwill you have to calculate. So first, goodwill is 8 million. Now unrecognized NCI, because NCI is not recognized in that one. How much? How will you gross it up? This is how you gross it up. Please learn this here. Okay. NCI is 20%. Group is 80%. So it's always the NCI percentage over the group. If it's 30, if 30 was the NCI, it would be 30 over 70. That's how, not 20 over 100, 20 over 80. Into how much? 8. Because goodwill is 8. So it's 2. Okay. So this 2, 10. So total notional goodwill is 10. It's not national, it's total notional. Please understand. Okay. Total notional goodwill is 10. Now net asset, because you need this to compare it with the net asset. You have to, with net asset, you have to add the total goodwill. You just cannot add this 8, which is for the parent. Okay. So now, just a minute. 60. Okay. 60 is the net asset. So it's 70. With 70 comes recoverable amount. This is carrying amount, which is 64. Recoverable amount will not change. It will remain 64. This becomes 6. Impairment now becomes 6. Okay. But this 6, how do you recognize it? Only the group share of goodwill will be recognized in the financial statements. Okay. That means even for the impairment also only 80% of the impairment will be recognized. So if you see 80% of 6, it will be 4.8. Okay. So it's 4.8. This impairment will go. Now we'll be doing test to understanding 11. Test to understanding 11. Happy. Okay. So calculate the impact of the impairment review. This is similar to your illustration 4. Okay. Here NCI fair value is 130,000 and B NCI at proportionate method. So how it will affect your impairment. Okay. So goodwill, here earlier you were given the goodwill. Here you have to calculate the goodwill first. Okay. So goodwill is fair value of consideration. Okay. Your consideration plus your NCI minus net asset. So your consideration is how much? 500,000. You have purchased it for 500,000. Okay, 500, dropping the 3 zeros. Now, fair value of NCI. You have to add. Fair value of NCI is how much? 130,000. Okay, which is 630. Net asset, excluding goodwill, is how much? 520. Sorry, 590. I'm sorry. Net asset at acquisition is 590. Okay, this is at 31st. But this is at acquisition you have to take. Net asset at acquisition. So 630 less net asset at acquisition is 590,000, which is 40,000. So goodwill is 40,000. Okay. And what about impairment review? You have to see whether there is any impairment has been done or not. Let's do an impairment review. Impairment, IMP, I'm using short form. Okay. How are you going to do the impairment review? Just check the goodwill, net asset and the recoverable amount. So now you have calculated the goodwill as 40. So goodwill is 40. Net asset is, they have given you. Net asset at the reporting date you have to take 520, this one. $520, which is 560 is your carrying amount, CA, and your recoverable amount is RA is how much? They've given you the recoverable amount 530,000. So it's 30. So yes, there is an impairment of 30,000. You see? So this impairment you have to reduce from here. Okay. And it becomes 10. You see, your goodwill is reduced to 10. So when you're writing it in this, remember only the percentage, the group's percentage will go. You have to allocate it between NCI and group. Okay. This 30,000 impairment, this 30,000 impairment will go. So you are taking 80% of 30,000 and 20% of 30,000. This will be 24,000. This will be 6,000. This is NCI, this is group. Always take the impairment. Don't go and take the goodwill. Okay. So this will go to both of this will go to P&L. This will go as an expense in the P&L. Now we are using the second method, proportionate method. So here, fair value of consideration will be same, 500,000. Okay, but NCI will change. NCI at acquisition will change. How much? NCI was 20% at net asset. What was the net asset at acquisition? 590,000. So 20% on 590,000 is how much? 118,000. 118. So which will be 618, and you are taking off net asset is 590. It will not change. So goodwill now becomes 28. Okay. Goodwill now becomes this one. So now we have to do an impairment review again. Okay, first is goodwill, which is 28. You have to add, you have to gross up the goodwill. This is proportionate method, unrecognized NCI. How much? It's 20 over 80 into 28, which is 7,000. So when you add, it's 35,000. Okay, 35. With this is total notional goodwill, TNG, total notional goodwill. With this you add net asset, which is 520,000. You add the net asset at the acquisition, okay, which is 555 is the carrying amount. Then the recoverable amount, which is 530, which is 25. So impairment is 25. You see? So when you're taking, okay, you have to take the group's percentage of this 25. So 80% goes only the group's percentage, 25, which will be how much? 20,000. Now we'll be doing test your understanding 12. Test your understanding 12 Pauline. Okay, you have been given the extracts from the statement of financial position of three companies, Poland, Sonia, and Arthur. Okay, you have been given non-current assets section and the equity and liability section. Okay, so now let's read about. And wait, first let us read the requirements. There are three requirements. So this is a big question. Okay, we'll go one by one. First we'll finish with A, then B, then C. You need to discuss how to determine the carrying amount of goodwill that arises on the accusation of Sonia. Okay, so first one is about goodwill. Second, you have to discuss how to account for the investment in Arthur in the consolidated statement of financial position. So this is only relating to Arthur. And C, you need to prepare non-current asset section of the consolidated statement of financial position. So this is only the extract, only the non-current asset part. Okay, please understand, you need your A and B to answer C. You directly cannot jump to C without doing A and B. It follows, you need to follow an order because you need the answer of A and B for C. Okay, so they are very much dependent. C is very much dependent on B and B is very much dependent on A. Okay, so it's up to you. You can choose any company, whether Sonia or Arthur, any company you can answer first. Sonia looks, there is many information on Sonia and Arthur is just a small piece of information. Okay, so first we'll finish with Arthur first. On 1st of April 2007, they acquired 30% at cost of this much per share in cash and recorded this in separate financial statements. So this looks like it's not a subsidiary, it's an associate. Arthur looks like an associate because it's less than 50% and more than 20%. So from 20 to 50, it's an associate. You need to know how to deal with associate. IS 28 deals with associate. We have already finished it, right? But no worries, when it's a group accounting, there'll be mix of standards that you need to go through. Like IS 28, IFRS 9, then IFRS 10, IFRS 3. There'll be so many standards together in a group accounting question. In your question number 1 in SBR. That's why you need to be very thorough with your group accounting standards. There are so many standards that creates group accounting questions. Okay, associates, joint ventures, financial instruments, subsidiary, right? Sonia. On 1st of April 2007, he have also purchased, Poland purchased Sonia, right? He has purchased it for 6 million of equity shares by exchanging one share in Poland for every 2 shares in Sonia, plus 1.25 per acquired Sonia share in cash. So can you understand, he has acquired it how? Not entirely through cash, also shares plus cash. You need to calculate the consideration here. Okay, the market price of each share, Poland share, is 6 and market price of Sonia share is 3.25 on acquisition. Now the cash consideration transferred for the acquisition has been recorded in Poland in a separate financial statements, but the share consideration was not recorded. In addition, 1 million of professional cost as related to the acquisition are included in the cost of the investment. So you have to deal with the professional cost also. Now, at the date of acquisition, there was an internally generated brand which was unrecognized. Okay, and they have given a fair value to it, fair value of 2 million and an indefinite life. Then they have an NCI measuring it at fair value. They have a policy of measuring NCI at fair value. Okay, and you can use your share price for this. An impairment test has been done and a recoverable amount was 34 million. So this one is this thing. You don't know whether Sony is a subsidiary yet or not. Okay, you need to find out because they didn't tell in terms of percentage how much they have acquired. They told in terms of cash and shares and all. So you need to work out the percentage. You need to go backwards. But through information given, you can find it out. So first we'll finish with Sonia. It has a major part to do. Then we'll go through Arthur. Okay. Because part B is Arthur. Okay. A is only dealing with Sonia. Because the moment they ask how you are calculating carrying amount gives you a hint that this is a subsidiary. But you also need to know how to find out. You need to know that percentage. Because if you don't know the percentage of how much you have acquired, you will not know the NCI percentage. You need to know that. Okay. A is a long one. Okay. B is a small one. So before we come to B, first we'll finish with Sonia. Okay. We'll go one by one. When you're calculating goodwill, see, this is how you start the answer. Okay. It's a big answer. You need to break down this big piece of information into chunks, because then only you will be able to write. You will not know where to write, where to start, where to end. You need to know the starting, you need to know the middle part, you need to know how to end it. This is a very important skill that you need to develop, okay, in all your professional level in your ACCA journey. Okay, so because the starting point is always reader requirement. What is that keyword that they are asking you? The keyword is goodwill. Remember the formula. How do you calculate goodwill? Break down this goodwill into, okay, let's do that. Okay, so let's break down this goodwill into three things. You need three things to calculate goodwill, isn't it? One is your consideration. You start with your consideration. This consideration also has many parts to it. One is share, one is cash, and rest other things, contingent consideration, deferred consideration, and all those things. But here we don't have all those things. We only have two. One is share, one is cash. So this you can further break it down. Okay. Next, after consideration, okay, what else? You need NCI, fair value of NCI. Third, you need fair value of net asset. So you need these three things separately to deal with. So your starting point is consideration. This is how you know what you need to start with. This is how you need to break down like this and see. So first is consideration. So that will be your subheading. Use your subheading. Consideration, you need to use subheading. Okay, write it in bold. Then you break it down. One is cash, one is share in different paragraphs. Okay. Which standard deals with consideration? Which standard says that consideration has to be measured like this and this? IFRS 3. IFRS 3. Business combination. IFRS 3 says when you're calculating goodwill, consideration should be at fair value. Right? You have to state like that. IFRS 3, consideration at fair value. I'm using the bullet points, okay? This has to be at fair value. That's what IFRS 3 says. Now, hit. Start with share consideration or cash consideration. Anything you can start in any order. Let's start with cash, share first, because that they have mentioned first. Okay. So, Poland has issued how many shares? You need to go back. First, they have always follow the order of the sequence they have given you. First, they have started with share. Then they have started with cash consideration. So, we'll also, when you are answering, we'll go by the equity shares. Okay. So, here, one share for every two shares in Sonia. Okay. Here, 6 million they have acquired. One in Poland for every two in Sonia. So, here. Here when you are calculating, it will be half of 6, because for every 2 you are getting 1 Poland share for every 2 of Sonia shares. So you take half of this. Okay. It's like the ratio you have to take. Poland, Sonia. For Poland, everyone you are getting 2 of Sonia shares. Okay, so if they are taking, wait, I need to go up. 1 share in Poland for every 2 shares in Sonia. Okay, Poland acquires 6 of Sonia's shares, 6 million of Sonia's share, 6 of Sonia's shares. This ratio you have to take. So how much it will be in terms of Poland they have issued? If 1:2, or if, I mean, see, for Sonia, if there's 2, there'll be half of it is for Poland. So if 6 is for Sonia, half of it will be for Poland, which will be 3. In other words, you are taking 6 divided by 2 multiply by 1. Okay, or half of 6. That's how you are getting 3. You need to understand these ratios because it's very difficult. I know students often struggle here to find their shares, correct shares. So 3 million shares has been issued by Poland. This is in the second paragraph you can write. Okay, 3 million shares Poland has issued. Okay, valued at fair value of 6 each, $6 each. How? They have given you the price. Yes, you see here 6. Poland's share is at 6. So that you have to multiply by 6. You first have to find the number of shares, 3 million shares. Once you found the 3 million shares, multiply by 6. So 3 into 6, which will be 18 million shares. Okay. So when you're taking it, how will be the credit entry? There should be a credit entry that has to be done, right? When you're taking this in the goodwill, it will be debited, right? Where will the credit entry go? Remember, this share consideration will be included in your goodwill, because when you're taking purchase consideration for goodwill, it includes both share and cash. That's why this will go there. Okay, so that is debited in goodwill, but where it will be credited? In equity. This is credit entry. Okay, 3 million for equity, because they have issued 3 million shares, and remaining 15 out of 80 is share premium, where it will be credited. You don't have to show, but it's better to write it. You'll get points. Okay, so this is how 18 million. Now we are coming to the third paragraph, which talks about cash consideration. I think now you got an idea of flow of how to write an answer. Cash consideration. How much? They have given you the price and shares. So here they told plus 1.25 per acquired Sonia's share in cash. So it's 1.25 into how many? How many? Into 6. 6 into 1.25. How? Because Poland's share at the date of acquisition was 6 million and the market price of each Sonia share. Sorry, Poland's share at the date of acquisition was 6. You have to take the Poland and multiply it with 1.25. This is for the cash. Okay, cash price. So it will be 6 million. This much shares you have acquired in Sonia. Price they have given when is for cash, it will be 7.5. And what about the third paragraph? We'll talk about professional fees. Okay, this needs to be ignored. Okay, this 1 million they have included in where? They have included it in the investment, but it's wrong. You should not take the professional fees, rather it's an expense. So this is incorrect. Okay, the treatment is incorrect, the current treatment. So this must go as an expense in the P&L. You have to take it out. from the investment. Next, fair value of net asset. Or NCI also you can take. Anything is fine. Okay. This also must be taken at fair value. Okay. So, the carrying amount of the Sonia's net asset. Okay. How are you going to take the net asset? You have to see from here. When you are taking, remember. Okay. You have to take this. Oh wait, just okay. So here they've given you the recoverable amount and net asset. Okay. So here when you're taking it, okay, you have to take this thing, Poland's share. Okay. Even if it's subsidiary, you cannot add equity shares of the subsidiary. You always take the parent, that is Poland. So this 20,000 and the retained earnings. On what date? On 31st March 2007, at this date. Acquisition date. Okay. So this retained earnings you have to take to find the carrying amount. So with that 20, you have to add this 12,000 of Sonia retained earnings. Okay. So you add the 20 with 12 of retained earnings. And you get 20. Sorry. 32. Okay. This is in individual. Okay. Carrying amount of Sonia's net assets in its individual financial statements. I'm sorry. It's not 20. It's 8 plus 12. I'm sorry. It's 20. Individual financial statements is 28 because here it's 8. You have to add this too. I'm sorry. This is when we are consolidating, we have to take, but we are not consolidating yet. Where we at post acquisition with the parents equity. I'm sorry. Okay. 20. Next. So this is the carrying amount of net asset. Okay. NA of Sonia. Remember, when you're taking net asset, any assets has been mentioned, you have to write it here. Okay. They have talked about an brand name and they have given you fair value also. So now we are talking about the brand name here under the fair value of net asset. Okay. First, you need to understand that brand name is an identifiable asset. You can sell it individually. Therefore, it has to be included in the consolidated financial statement. Okay. So it has been 2 million. So this 2 million will be added with this 20 million. So now fair value of net asset becomes 20 plus 2. 2 is from that brand name, 20 is from that what we have calculated, 22. What about the you have to talk about amortization also. See, brand, okay, has an indefinite useful life. So if an intangible asset has an indefinite useful life, what should you do? What is the treatment? According to IAS 38, it will not be amortized. Will not be amortized. If it had a finite life, they will give you the useful life. 5 years, 10 years, then you can amortize it. But here, you cannot. It will not be amortized. And it should be reviewed annually for impairment. But it should be reviewed annually for impairment. This is for indefinite useful life asset. Next, NCI is the third subheading. This is also at fair value. Okay. So now, how are you going to get that fair value? You can use, for NCR they have told something. You can use the share price of Sonia. Okay, so here the market price of each Sonia share at the date of acquisition was 3.25 each share. So for one Poland, every 2 shares in Sonia, every 2 shares. So it will be 3.25 into 2. Okay. So here it will be 3.25 into 2 for every 2 share, one Poland, which will be 6.5 million. Okay, this will be the fair value of NCA. Now calculate the goodwill. What's next? They told you to calculate goodwill. That was the requirement. So goodwill will be fair value of consideration. Okay, share exchange, share consideration, cash consideration. Share consideration was how much? 18,000. We'll drop down the 3 zeros. Okay. Next, cash was 7,500. Then fair value of NCI 6,500. Then you need to deduct net asset, which is 22,000. So 10,000 is the goodwill. That means 10 million in short. Okay. Now, next paragraph is impairment. This will be your subheading. Whenever goodwill is there, next comes impairment. You have to see whether impairment has taken place or not. Okay. So you have to review it annually for impairment, the goodwill. Okay. So now you will see this, right? Take the net asset and then check it with the recoverable amount. You have been given the recoverable amount, so you can find out. So now this is how you will do. This is a net asset. You will add your goodwill with your net asset. Goodwill is 10,000. Net asset is, okay, when you're taking 22,000, remember net asset when you're taking, you cannot take this 22,000 because this 22,000 you are taking at the date of acquisition. But when you're taking this net asset for impairment, you have to take at the reporting date. So here you have to take net asset from here. Share capital, retained earnings, RE, brought forward, profit, and brand because it's a non-current asset. So share capital is 8,000. That is 8 million. Retained earnings was 12. We just checked before. Profit for the period. How much? 5,500. 5,800. This is the profit. And the brand 2,000. See, whatever they have given in the additional information only you have to take. Okay. You don't have to take all this property, plant and equipment and all these things. It's not needed. But brand we are taking because it is given in the other information below. Okay. Right. At the date of acquisition, see, this was unrecognized in the separate financial statement. That means when they took the net asset, they didn't take this. It was unrecognized in a separate financial statement also, the internally generated plan. That's why we have to take it when you're taking the net asset. If it was taken that time, we should have not taken it again. But since they didn't take it, we have to take it. It was unrecognized in the separate financial statements also. So it is 27,800. So you add it with 10,000, 37,800 carrying amount. Recoverable amount is how much? It is given as 34,000,000, which is 3,800. So this is the impairment. Okay, but when you are taking this impairment, you are only taking the parent's percentage and NCA percentage. You have to separate it because this is fair value. Okay, so when you are taking it, remember goodwill was 10 million. Okay, and this is 3.8. That means it will be reduced to, goodwill will be reduced to 6.2. This will be the goodwill, and this 3.8 will go as an expense in P&L, statement of profit and loss. But you need to understand what is the percentage only. Have they given? No. And here let's calculate it, how much they have got. You have to find the percentage first. This is based on the shares issue, you can find out. 3. This is something which has to be there. They have acquired $6 million. 3D. Okay. Anyway, the percentages are NCI is 25% and parent is or group is 75%. You need to find out this percentages also. Just what I'm struggling a bit here. But you will get it from here only in the first paragraph, from the number of issued shares over the total share to get it. Okay. So here, Poland have issued 3 million shares. So if you take 3 million shares, okay. Hmm. Okay, we'll come back to that later. But first we'll finish with the 75% and 25%. Okay. So when you're taking the impairment, so this is how you get 75% of 3.8 million. That impairment, which is 2.85 million, will go to group. And balance will go to, which is 25% of 3.8 will go as an NCI, which is 0.95. Okay. But we'll come back to that and see how we got 75% and 25% later on. Let's finish with B, which is author. This is an investment in associate because 30%. Okay. And it is dealt according to IS 28. You need to write this information that it's an associate. And IS 28 deals with it. Okay. So because it's an associate, understand, you cannot consolidate it. You have to use equity method for it. You have to mention this in your answer. You have to use these words. These are keywords. Otherwise, you're going to throw a valuable marks away if you don't write equity method, associate, IS 28, right? By specifying the percentage, that is 30%. Okay. So you will initially recognize it at cost. Initially at cost, you will recognize the associate. How much? We'll see how much you have bought it for. Where is also? It is 30%, 7.5, okay, per share. Per share. How many share? 8,000. 8,000 share. Or 8 million because you're dropping down the 3 zeros. So this is how you need to connect the information, okay? You will not get everything in one place. You see where I got the 8,000 and where I got 30% and where I got 7.5. They are in 3 separate places. So initially at cost it will be 8 million into 30% into 7.5, which will be 18 million. Okay. Now Poland, because Poland is the parent. Remember, parent will only account the other's post-acquisition profit, the associate's post-acquisition profit. That means the Poland's share of the associate's profit. They will account for it. How much? So Poland, because it's the parent, will account for its share. That means Poland's share of Arthur's post-acquisition profit. So it will be 30% only. 30% of the profit. How much is the profit? It is this. Post-acquisition profit is this only. The down one. 10,000. Or 10 million. So 30% of 10 million, which is 3 million. Okay, so this will be credited. This is an income. Okay, it will be credited in P&L and debited in investment in associate. So you add both 8 and 3, which is 21 million. This is how you recognize your associate at 21 million. Okay, so when you're carrying it in the consolidated statement of financial position, it will be a 21 million associate. Now we are coming to see extracts, non-current asset. So property, plant and equipment. Okay, non-current asset. Property, plant and equipment, you have to add both the sides. Okay, you have to add 36,800 plus 20,800 only, because only this is a subsidiary. This is an associate, you do not add. Coming to goodwill, there's one more. Investment will cancel off in consolidated. Author will not remain there. I mean, it will be there, but you will write it investment in associate. So here, now you will have goodwill. Okay, so here first we'll show 36,800 plus 20,800, which will be 57,600. Then we have goodwill. We have calculated it in A, which is 6,200. You have to remove your impairment. We calculated goodwill at 10 million. Impairment we got 3.8. 10 minus 3.8, 6 million. 6.2 million is the goodwill. Intangible asset also will come, which is 2 million. That means 2,000. Because we did not recognize it. And then investment in associate will also come under non-current asset as a last item, which is 21 million. 21,000. If you add it, you will get 86,800. You don't have to balance it because they only told non-current asset section. Okay, if you do it more, remember you are losing marks. Sorry, you are losing time and you're not getting any additional marks. Okay, 86,800. So that's it. We are done. Now, let's see how we got that 75 and 25%. Okay, I have given you the hint. It is from your part A, I mean first para. You will get it. It is based on the shares issue that you will get. Okay. Let's work out some time. This is the last question, so we don't have to worry so much. We can take our time. Okay, some more time before we conclude the last section of this lecture, which is exemption from consolidation. Okay. They have issued. Okay, anyway, we'll leave it for time being. Okay. But it is something to do with this 20,000. Okay. It starts from here. The shares that you have issued divided by 20,000. Okay. But if you are doing it, you are not getting 75%. That's the thing. The old credit entry is same. Remember in this one, share premium was 15,000 and equity was 3,000. Okay, credit entry. That 18,000 that you have issued, out of that 3,000 is this and 15,000 is share premium. The credit entry. Yeah. Because they have issued 3 million shares. So that means when they have issued 3 million shares, you are left with 15. Okay, they've issued this. So 15 million. So 15 or 20 million will give you 75%. This is how you're getting it. It's a little tricky, okay, but this is how you actually get it. Okay, because you have issued the entire 3 million from equity, so you only left with 15 million from that 20. That's how you get 75%, and therefore NCA is 25%, the balance. This is the last part of this lecture, which is exemptions from consolidation. Intermediate parent companies. What is the meaning of intermediate parent? Intermediate parent means he as a subsidiary and is also a subsidiary of another company. Okay, this is how it looks like. For example, Y is an intermediate parent. Why? Because Y has a subsidiary which is Z, and Y is also a subsidiary. That means the parent is also a subsidiary of another company which is X. So he's in between. He's a parent also, he's a subsidiary also. Parent to someone, subsidiary to someone. So that middle person is known as intermediate parent. Okay. Now, IFRS 10 permits an entity not to present group financial statements if all of these conditions apply. Number one, if it is wholly owned. Wholly owned means there is no NCI. They are owning 100%. Or even if they are partially owning it, NCI does not have any rejection, any objection for non-preparation. If you don't prepare, NCI won't mind. They have no objection to it. So under that condition, you are allowed not to present group financial statements. Second reason, when your debt or equity instruments are not traded in domestic or foreign market, or you are not in the process of having those traded, the debt and the equity instruments. The last, when the parent already produces consolidated financial statements. Parent entity produces consolidated financial statements that comply with IFRS standards and which are made available to the public. So in this case, you are allowed not to present group financial statements. You are permitted. Next, if you are permitted not to consolidate, not to present group financial statements, what should you do instead? IS 27. You have to use IS 27. Take help of IS 27. IS 27 we have already covered. It is separate financial statements, and this is required in certain areas. And IS 27, you have to make this disclosures. Number one disclosure is that you have not presented consolidated financial statements. Number two disclosure is you have to list all your significant investment in joint venture, investment in subsidiaries, investment in associates. Okay, and you have to give the percentages also, how much percentage you're holding in them, also the principal place of the business and the country of incorporation. All this has to be disclosed under IS 27. Third, what was the basis of those investments that you have listed above, why they were not, why you are accounting for them in separate financial statements, what are the basis? You have to give that basis, the reasons. Okay, now investment entities. See, investment entities, what is investment entity? First understand that investment entity, number one, they obtain fund from investors and provides them with investment management services. You are giving them some services for managing their investment. In return, you are getting a fund from the investor, and you are investing those funds. Why? To earn capital return or investment income, or both. Let's say the value of the land went up or the value of your building went up. You are getting the return. That is an investment. Okay. See, you measure the performance based on fair value basis. You measure the performance of your investment on a fair value basis. So if these three conditions are there, it's an investment entity. An investment entity are excluded from consolidation. You don't have to consolidate. Okay. Even if they have control. Even if you have a control over an investment entities, they do not consolidate. What should you do instead? Instead, they measure their investment at fair value at each reporting date, and any gain and loss goes to profit and loss. Okay, they do not consolidate. Even if they have investment over which they have control, they do not consolidate the investment. This is only for investment entities. Please understand. In your exam, you have to see what entity are you. If you are an investment entity only, you are exempted from consolidation. Otherwise, no. And to know whether you are an investment entity or not, you have to see these three conditions. How you are obtaining the fund, how you are investing those funds, and on what basis you are measuring. Is it on fair value? Are you investing on capital appreciation, on investment income? And are you obtaining the fund from the investor for the investment management services? Okay. Then invalid reasons for excluding a subsidiary. That means you are not allowed to exclude if this other reason. They are invalid reasons. Number one reason could be long-term restrictions on the ability to transfer funds to the parent. A subsidiary might say we are not able to transfer our fund to the parent because of some restrictions. Maybe government had put some restrictions. You cannot. You still have to consolidate. Second, subsidiary is making some different activity and operates in a different location than the parent, or rest of the other, or they are different from the rest of the group members of the group. Still, you have to consolidate. Third, subsidiary has made significant losses and has significant liabilities. Still, you have to consolidate. Fourth, the directors may seek to disguise the true ownership of the subsidiary. Why they might exclude? Because they do not want to show the true ownership of the subsidiary. You have to consolidate. These are invalid. And the fifth reason, they may exclude a subsidiary from consolidation in order for the group to disguise its true size and extent. This can happen. Why? For the tax purpose. Because if you show larger group, larger profit, more tax. If you try to show yourself smaller, you don't have to pay huge tax, right? This could be for various reasons. One biggest reason is tax, to evade tax, avoid tax, right? So now the last is special purpose entities. The special purpose entities are created by the parent, okay, for some specific purpose. Okay, it's a subsidiary created by parent for some specific purpose. Okay, but remember, SPs are separate legal entities. Okay, that means they are liable for their own debt. Okay, they might be used when the parent goes for some new or risky venture. Okay, or maybe alternative could be parent might set up this SPs to hold some of its debt, which will improve the parent's separate statement of financial position. Okay, so there has been instances of groups not reporting this SPs in the group financial statements. Remember, this is a breach of IFRS standard. You have to show. A parent has taken SPs, you have to show it in the group financial statements. You cannot exclude it. Okay, you're breaching IFRS standards. And remember, if the parent controls the SAPs, the special purpose entities, assets, liabilities, income, and expense, you have to consolidate. It must be consolidated. Okay. So that's it for the IFRS 10. The first part of IFRS 10. The second part will be the next lecture. So here we went through group statement of financial position, the group structure, the pro forma and adding and workings 2 to 5, all the goodwill, NCI, net asset, group retained earnings. Then group profit and loss, other components of income. Here also we have pro forma and adding, and we need to split the profit between the group and the NCI. Okay, profit and TCI. TCI is total comprehensive income split. Control means having power, right to variable returns, and ability to use power to affect returns. If these three things is there, control is there. These three things only comes when you have to base your decision not just based on the percentage. Okay, when more information is given to you. If nothing has been mentioned and only the percentage, let's say they have acquired 60%, 30%, then based on the percentage, you will say whether control is there or not. If it's more than 50%, control is there. If it's less than 50%, no control. 20 to 50, power. 20 to 49, sorry, 20 to 49, only power is there, no control. Sorry, yeah, power. So it's a power to influence. So power to influence means it's an associate. And if it's less than 20%, it is a financial instrument, debt instrument or equity instrument, which is under IFRS 9. Okay. Impairment of goodwill. Goodwill calculated under proportionate method must be grossed up. But if it's under fair value method, you just add it with net asset and compare it with the recoverable amount. That's it. So thank you for watching this lecture, and We'll see you in the next lecture, part 2 of this, which is again a very important from your exams point of view also, because both part 1 and part 2 you have to study it together when you're studying it. Okay, it's together. Don't treat it in isolation. This is not separate from the remaining. In fact, the next is the continuation of this. Okay, and it's going to be lengthier and bigger than this one, right? With more questions and more concepts to go through. So see you in the next lecture. And if you haven't watched my channel yet, please don't forget to subscribe to Sabi Akhtar. And there's a whole playlist on SBR, SBL, AFM, and audit and assurance, advanced audit and assurance. You can go and watch it out. And if you want my lectures, the slides, what you need to do is go on my channel, Sabi Akhtar, and go to the about section. And below you will see there are so many links given to that. Okay, the ACCA material is for the textbooks and all. You will get all the textbooks and the revision kit, Kaplan, the latest one that is available till June 2023. And um, if you want my slides, the presentation, it is based on it is the names is given. For example, ACCL AFM lecture or SBL lecture. It is given like that. All the lectures, the slides you will get there. You can download it from there. I think I have four subjects: AAA, AFM, SBR, and SBL. All SBL lectures are out there. Go click it and download it. See you.